This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our study of capital allowances so far, we've limited ourselves to one set of transactions, purchases. But we're now able to determine whatever the asset is that's been bought during the accounting period, we'll be able to identify which exactly capital allowance will be available. Is it normal items of plant and machinery that would attract an AIA? Is it items of acquisition, basically motor cars that are not low emission cars, but cars with emissions from 51 grams per kilometre upwards? Those cars do not get AIA, they do not get FYA, they get WDA. And hence we can determine whether that's going to be a main pool item at 18% per annum or a special rate pool item at 8% per annum. If, as we've just said, it is a low emission car, then an FYA is available. So the first thing we've done, and we should now be able to do successfully, is determine for every asset listed as being purchased during the period, is it qualifying plant and machinery? If it is qualifying plant and machinery, what does it qualify for? If firstly it's AIA as normal plant and machinery, is it normal plant and machinery that would go to the main pool, or is it that special rate pool expenditure? Because we've got a mix of the two, and we've got more than £200,000 in total spent, then the available £200,000, again given a 12-month period, the available £200,000 is going to be allocated where? It's going to be allocated to the special rate pool expenditure. We deal with the AIA, any residue left over that has not ranked for AIA, like we've spent more than £200,000, is allocated to the relevant pool. If then it left to the special rate pool, otherwise thereafter to the main pool. Once done, we've then been able to compute and deduct the available capital allowance at either 18% or 8% respectively on those two pools. We then, having got the WDA for the period, brought in finally any low emission cars and got the FYA. But of course, in reality, as well as buying during the period, we may well sell. So we're going to deal with both additions and disposals. So dealing with those disposals, the sale now of our plant and machinery. Simple rule, when plant and machinery is sold within the accounting period, we will take the sales proceeds up to a maximum of the original cost of the asset, and deduct it from the balance of the unrelieved expenditure on the relevant pool. Now, second-hand plant and machinery. Is it at all likely that we're going to sell that for more than original cost? No. So in which case, therefore, in reality, 99.99% of occasions, you will be deducting the sales proceeds because it will be significantly lower than that original cost. Having deducted the sales proceeds to that max of original cost, that will be done again at the point of having dealt with additions that rank for AIA, having dealt with additions that rank for WDA, then we deduct our sales proceeds in determining the tax written down value on either the main pool or the special rate pool that then will be eligible for the relevant writing down allowance. So when plant and machinery is sold, it's probably going to be sold for sales proceeds that are significantly lower than original cost. We deduct those in our pool columns, main and special rate, and we deal with those disposals after we've dealt with, firstly, additions for AIA and additions for WDA. Only then do we take out our disposals. Again, we'll show that in a few moments' time. If you did have the very strange situation in reality, but examiners don't always have to reflect reality, they like to put a challenge your way every now and again. If we had a situation where we'd bought for £10,000 and sold for £11,000, it is £10,000 the original cost, not the higher figure of the sales proceeds that would then be deducted in determining the balance on our pool upon which then to compute any available WDA. Okay. We'll show that in a moment, but what you might get is as a result of the deduction of the sales proceeds, that where the tax written down value of either the main pool or special rate pool prior to calculating the WDA, as we've just said, if that figure on which you're about then to compute the WDA, if that is less than £1,000, the entire balance may be taken as a writing down allowance in that period. So once, prior to computing the WDA for an accounting period, once the figure on either main pool or special rate pool, if that has come down, maybe as a result of a disposal during the period, but if it's come down to a balance of less than £1,000 here, then you are able to pick up the remainder of it rather than just picking away at this very small number on a reducing balance basis, remember, at either 18% or 8%. HMRC say it doesn't matter. Don't worry about small writing down allowances on those small balances. Just take what is left. It's a figure of less than £1,000 and you can take the full amount as a writing down allowance. Sensible move on part of HMRC. Right, so what have we got here in example 1? Beth prepares accounts to 5th of April, so she's decided to have an accounting period synonymous with the tax year. The written down value as at the 6th of April 18, so the start of what will be the year ended 5th of April 19, for which we of course have got to calculate her capital allowances for the period. So at the start of this accounting period, her main pool, a lowly figure of £1,250 there. What does she do during the period? She purchases machinery for £10,000. So normal purchase of a normal item of plant and machinery for £10,000. That therefore is AIA. Now it would be AIA main pool expenditure, but as that's the only item bought during the period, it is very clearly less than £200,000, so there's going to be no limitation. All of that will be entitled to AIA, 100% AIA. There'll be no residue to go to any pool, be it main or be it special rate. 100% AIA. What does she also do during the year? She sells an item of plant for £500. Now, of course, as they tell you what the individual cost of that was. It was £3,000. And again, not surprisingly, we're selling it for significantly less. So the figure to use in our CA computation is £500. So, what columns do we need? Do we have any expenditure during the period that is ranked for either AIA or FYA? Yep, we've got the purchase of machinery for £10,000. So we need our AIA column. Do we have a main pool? Yes, we do. We need a main pool column. Will there be allowances to compute for the period? Yes, there will. So we need an allowances column. What goes where? First thing to do, pick up your opening tax written down value on your main pool. First exercise done. Secondly, list out any additions that rank for AIA. Machinery, £10,000. And on that, you will claim your AIA of 100%. That's a £10,000 AIA and nothing to go into the main pool. So the main pool is still £1,250. We then deal with disposals. Now again, if there were any other additions that rank for WDA, those would go in before dealing with disposals. The only thing to be dealt with after dealing with disposals and then after computing the available WDAs would then be finally any FYA expenditure, i.e. the low emission cars. But otherwise, pick up your tax written down value brought forward, bring in your AIA expenditure, look for any main pool or special rate pool expenditure, i.e. other additions, i.e. cars, put those in, and then deal with disposals. Well, we haven't got any cars bought during the period, so it's just the disposal. What have we got to deduct? £500. What do we deduct it from? The pool tax written down value brought forward, £1,250. What will that do to the number? It'll take it below £1,000. meaning under this small pools WDA rule that the residue there, 1250 less 500 is 750, that can be taken and will be taken as a small pools WDA claim. We won't have to do 18% on that figure and continue and continue and continue on that reducing balance basis. Now it's gone below 1,000, we can pick up the residue as a small pool WDA claim, the full 750. Let's just have a little look at what that answer would look like. Again, we knew we needed our AIA column, we knew we needed main pool, we knew we needed to record the allowances of the period. We started with our opening tax written down value. We had the additions and with it the AIA, eligible for the 100% allowance, nothing in the pool, allowance is 10,000. Then we take out our disposals, limited to sales proceeds to a maximum of original cost. That brings it down to 750. Prior to calculating any WDA, it doesn't exceed £1,000. So the small pool WDA picks up the full remaining amount of 750 and clears that to the allowances of this period. Again, deduct from the adjusted trading profit to give you your tax adjusted trading profit. Job done. Again, that type of exercise, in all honesty, probably more likely as an objective testing question rather than as part of a written question there. But again, we need to know how to deal with it. Going back to our notes. Now, we're probably going to have to deal with disposals in any capital allowance computation that we do. And we've said where we put that. Now, it's starting to get sort of a little bit more interesting now as we bring in more items. We've had the different types of addition, now we're dealing with disposals. And now we come to something that, again, is a regular feature within exam questions when dealing with income tax and the unincorporated trader. Non-pool assets. What we've seen is any expenditure above the AIA limit would be allocated to either the main pool or special rate pool, depending on the type of expenditure it was that we had incurred. We then have cars. If those cars are not low emission, they're depending on the exact emission by comparison to the CO2 emission limits that we have and are given to us on our rates and allowances page, we can determine is that car that we bought with those emissions going to the main pool or otherwise with higher emissions to the special rate pool. But that expenditure has been allocated to one pool or another. What we're now going to see is non-pool assets. Assets that will be kept separate on the capital allowance computation. It's going to have, each such one will have, their own column. Now again, that's going to mean you've got a fairly congested capital allowance computation maybe in real life. So there's only going to be probably one example of this in any exam question. Now what are these non-pool assets? Now by far the most likely situation where you're going to have to deal with this is this first one. Assets with private use by the business owner. So we say here, the following says assets will not go to either of the main or special rate pools, but will instead have their own separate column. If there were 47 individual non-pool assets, each one of the 47 would have its own separate column on the computation. We're probably not going to have to deal with more than one. So that, therefore, own separate column on the CA computation. There are two possible categories. This first one, by far the most likely, and is only relevant when dealing with the unincorporated trader. When dealing with the incorporated trader, you will not have any assets with private use by the business owner because we don't have a business owner per se. We have shareholders who own shares in the company. This issue of private use is only in income tax and only where it's private use by the business owner. More of that anon. The second one, rather more complex, short life assets on which the taxpayer has made a depuring election. This is available and probably more likely to be seen in a corporate tax context, but would be an issue for both income tax and corporation tax. But by far the biggest issue, the most important one, is this one: private use of an asset by the business owner. Now let's have a little think. In terms of the assets bought by the business for use within that trade, what do you think is the most likely asset, given the assets that we've seen qualifying for capital allowances so far? Which do we think is by far the most likely to have a mix of both business and some private use by the owner of the business, the proprietor of that business? I'd hope we'd be thinking that by far the most likely one is a car. A car bought through the business, but has a mix of, yes, some business use, but it's not all business use. Some of it is private. And private use isn't just going away on weekend trips away there, or going down to the shops at whatever point in time that you wish to. Private use is also going to your place of work. Again, that is still private use. Now, you don't have to worry here, because you'll be told. You'll be told what the business stroke private use split is. If you've got that, but only where it's business stroke private use split by the business owner, if you've got private use by an employee, we don't touch it here. That's just a normal pool item. Is it main? Is it special rate? What's the CO2 emissions of the car? But by far the more likely outcome is that we're going to have private use by the business owner on a car. Now, okay, it could be any asset they want to choose, but a car is by far the most likely one. You don't get the situation where, oh, it's Friday afternoon, I'm finishing work for the week, I think I'll take at home that lathe, that big item of plant and machinery that's in the factory. It's not going to happen. But the car is very much more likely to be the situation. So what do we do with them? Right, private use of an asset by the owner of the business. Now again, we keep specifying the owner of the business. Now that's going to be either, in terms of unincorporated, is it a sole trader business, or if it's a partnership, then a partner within that partnership. So we've got the owner of the business where it's partly business use and it's partly private. Typically, as we've already suggested, and I'm sure you'd agree, a motor car. Only the business proportion, of course, of the available capital allowances is given. This proportion is computed by reference to the percentage of business use to total use. You will be told what the business use is, what the private use is. The following rules must be followed when computing capital allowances. Right. What do we know? The cost is not going to either pool, but the cost, therefore, not brought in to main or special rate pool, but is the subject of a separate column. Now again, you can head that column up either as private use asset or state what percentage business use it is. It'll be something less than 100%, 60% business use, 80% business use, whatever that might be. So we set up a separate column for it. The writing down allowance, as it usually is in terms of most cars other than low emission, again, I mention cars because it's the most likely asset for this issue to arise upon, the cars get WDA. The only question is it 18% due to the CO2 emissions? Is it 8% due to the higher CO2 emissions there? So it's a writing down allowance. If it was a low emission car, it would be FYA. If it was some other normal item of plant and machinery that attracted AIA, which is incredibly unlikely, but whatever is the allowance of the asset, it's calculated on its full cost, but only the business proportion of any allowance is actually given. You're going to lose the private proportion of that expenditure, of that tax written down value in each accounting period that you claim your WDA. It would of course be a one-off issue if it was either AIA or if it was FYA there, as they are 100% allowances. But that, as I say, is incredibly unlikely. Far more likely it's a car, at a car that probably does not have low emissions. So it's not FYA, it's WDA that we're dealing with. What does that mean? Each accounting period from when you buy through to the period of sale, but up to the period of sale, we are going to compute our writing down allowance, restricting our 18% or 8% to the business use proportion in terms of the claim. Of course, on disposal, then when that asset is sold, we close down that column on the computation. And we close it down by after we've deducted proceeds from whatever was the tax written down value at the start of that period, more of that later. Once we've deducted it, whatever balance remains is going to be a balancing adjustment. Now, we've not yet seen these. I'll bring them in this context. So before we take this issue any further, let's work through a little example. Right. I've set up here our little example. We have our hero, or indeed heroine here, Teresa, prepares accounts to the 31st of March in each year. At the 1st of April 17, so the start of the year ended 31st of March 18, had a tax written down value brought forward on the main pool of £20,000. And from that starting point, we now have to deal with the following transactions. And rather than just looking at one accounting period, we're going to look at three, beginning with the year ended 31st of March 18. Now, we already know at the start of that period, we have a tax written down value brought forward on the main pool of £20,000. But now, she purchases a car with CO2 emissions of 100 grams per kilometre, so it's not low emission. That 100 is between 51 and 110, so that means we're in writing down allowance territory. What level of WDA on that level of CO2 emissions? 18%. Had those CO2 emissions been greater than 110 grams, maybe it was 200 grams per kilometre, then we'd be restricting any WDA claim to a mere 8%. And that car here with 100 grams, therefore an 18% WDA, Teresa has bought it for £30,000. For her own use, so hasn't bought it for an employee to use, Teresa, the proprietor, the owner of the business, has bought it for her own use. And we've had agreed an 80% business use in relation to that particular car. Right. How do we therefore put together the CA computations for these periods? You can see what happens next. Year ended March 19 there. There are no transactions. That doesn't mean there's no capital allowances. Year ended 31st of March 20. We then sell the car. And I've given us two alternative proceeds, but we'll come to those in a moment. So the first accounting period that we need to deal with. The accounting year ended 31st of March 18. Now we know again for this period that of course we always need our allowances available column. And we also know we've inherited a tax written down value brought forward on the main pool. Looking at what else we have, the only asset bought, the only purchase during these three accounting periods that we're dealing with is an asset that does not rank for AIA and doesn't rank for FYA. It's a car with 100 gram per kilometre CO2 emissions. It's a writing down allowance and it's an 18% writing down allowance. So in terms of the columns, there's no requirement for that little inside working column, the AIA stroke FYA column there. So what do we have? We have our tax written down value brought forward. That was at the 1st of April 17. Let me just remind myself, what was that figure? That was £20,000. 20,000. We then look for additions. Are there any additions that rank for AIA? there's no plant or machinery bought during this period, or indeed any other period that ranks for AIA. It's just a car that we have to deal with this period, and there's no other acquisitions in each of the next two periods. So we've got our tax written down value brought forward, no additions for AIA, so it's therefore, do we have any other additions, i.e. those that will rank for writing down allowance there? Yes, we do. We have a car that was purchased at a cost of £30,000 and which critically has just 80% business use. They could have said it was 20% private use, of course, there. It's the same outcome. We've got 20% private use, 80% business use. And that use is by the proprietor. So what does that mean in relation to our capital allowances computation? It means that that car at 100 grams per kilometre would normally go into the main pool, given those CO2 emissions. But it has private use by the proprietor. So what we now have to do, therefore, is to bring in this particular non-pool asset and show it in its own separate column. So it's the car and it's 80% business use. How much was it? It was £30,000. So we brought in the other additions. So having looked for additions for AIA, none. Additions for WDA, this, but it's a special one because it's a non-pool asset, for it has private use by the proprietor. We would then deal with, if there were any disposals during this accounting period. There weren't any. So what we've got now are our tax written down values on which to claim our writing down allowance. Now, there's no need to show it as such, but we'll just get the totals at this point prior to computing any writing down allowance. Now, on our main pool, what can we have on the main pool? 18% will be available on the main pool, as ever, per annum on a reducing balance basis. 20,000 at 18%, 2 times 1,800 is what? £3,600. And that 3,600 would transfer across, of course, into our allowances column. We then got the WDA available in relation to the car. It was 100 grams per kilometre, and on that basis, therefore, what do we get? We get an 18% writing down allowance, and that was, did I write 20 there? That is on the £30,000. Now then, you know that there's only 80% business use, so we're going to restrict the allowances that are claimed. But here is an important issue to look at. The allowance level is 18%, and we now deduct at this point all of that 18%. So 18% on 30,000, 3 times 1,800, 3 18s, 54, so that would be £5,400. Now normally, like we've just seen on the pool, that transfers across to the allowances available column. Not here, it doesn't. Are we entitled to claim all of that 5,400? No. Because we're going to lose out on 20%, we can only claim the business use. So times 80%. So I have my calculator ready and waiting here. So we've got 5,400 there times 0.8 equals, now I make that, just check it as well there, £4,320. So that's the allowance that is available out of 5,400 that was otherwise the full available WDA. But it is that 5,400 that is then deducted in determining the tax written down values to carry forward. 5,400 away from 30 is what? 24,600. On the pool, of course, it's just the normal rule. Take your allowance in full away from your tax written down value. 3,600 from 20 is what's not 17, that is £16,400. 16,400. Now the pool is fine, you just take the writing down allowance on a reducing balance basis, hopefully no problem there. But look at what we have done here in this particular column. We allocated the £30,000 expenditure into its own separate column because this car had private use by the proprietor. What figure ranked for expenditure, for allowance rather? Well, expenditure ranked for allowance, 30,000. What level of allowance? 18%. That gave you 5,400. Deduct that 5,400 in deriving the 24,600 to carry forward to the next period. Then restrict that 5,400 to the business use proportion of 80%. What that means is that the 20% of that £5,400 that is private use has now been removed permanently from the capital allowance computation. We've only been able to claim 4,320, but the tax written down value has gone down by the full £5,400. So don't make the mistake of simply calculating 18% of 30,000 times 80% equals 4,320 and then deducting that in your column to carry forward your tax written down value. No. If you had deducted 4,320 instead of 5,400 in this column, all you would have done is to delay the eventual availability of capital allowances on all of that expenditure. If you have private use by the proprietor, you don't just delay that allowance, you lose it. So we've now lost that difference between 5,400 and 4,320. It's gone. That is never going to be available for allowance to this business in the future. Okay. But we didn't stop there. That was the year ended 31st of March 18, where we bought that particular car. We moved to the year ended March 19, no transactions. Now remember, there may not be any transactions in this now, the year ended 31st of March 19, the next accounting period, the next capital allowance computation. We will therefore bring forward our tax written down values. What was carried forward at the end of the previous period is of course now brought forward. What were those figures? 16,400 on the main pool, 24,600 on the non-pool car here. Right, no transactions. There's no additions, there's no disposals. But we still get, of course, our annual writing down allowance. Now what do we get? We get our, not 20, we get our 18% writing down allowance on the pool, and that is your normal 18% figure. We then get, again, 18% in relation to our non-pool asset. But what do we do with that 18%? We restrict it to the 80% business use that exists here. We lose out on the private use, we only get to claim the 80%. But the figure to be deducted in there is the full 18% figure. Okay, just work those out for me please, if you would be so kind. I will do the same, of course, and I won't waste your time by doing that. We'll have a little pause at this point, put the numbers in, and hopefully we'll agree and see what happens then, as we'll then move through to what is the final period of the three that we have to deal with. The business obviously continues to trade, the one where we deal with the disposal of that non-pool asset. That's what's coming up next. But just pause at this point and you work out your numbers. Okay, so, well, arithmetic permitting anyway, hopefully we're looking at something not dissimilar to this. We brought forward our tax written down values at the start of this accounting period. They were, of course, on the main pool and this non-pool asset, this car with private use by the proprietor. On our main pool, of course, we had our normal 18% writing down allowance. Computed transferred across in full to the allowances available column. The asset with private use by the proprietor is the car, a car that is in that middle group, as it were, of CO2 emissions. It's not low emission, it's not high emission. It means that we get a WDA, but the WDA is at least the higher level of 18% there. That 18% is computed on, again, that tax written down value brought forward. That hopefully again gives us 4428 there. However, that is not the figure that we get to claim. It is then that you restrict that full 18% figure of 4428. It is then that you restrict to the 80% business use claim. And that, all being well, gives you there your £3,542. As ever, add up the allowances of the period, and that figure would be the figure to deduct from your adjusted trading profit to give you the tax adjusted trading profit to then go into the relevant income tax computation. Get your tax written down values here as we need them carried forward, and they of course will be carried forward into the year ended 31st of March 2020. What happened in the year ended 31st of March 20 here? We've got the car being sold. And what we've done, for reasons as I'm about to explain, is to put in two alternate figures of sales proceeds that we might have to deal with. We've got a lower figure, we've got a higher figure. Let's look at what happens on this. So going back to the start of the year ended March 20, gone a bit too far there. Anyway, okay, we have our tax written down values brought forward at the start of the period. Again, the main pool is going to be no problem. We're just going to claim our normal WDA. But here we've got our £20,172 in relation to our non-pool asset. Okay, were there any additions during the period? No, there were not. Did we have a disposal during the period? Yes, we did. So prior to working out any WDA, we deal with our disposal. Right, here it's a very special disposal because it is of the non-pool asset. Now remind me, what was the first figure we used up there? £18,000. There we go, 18,000. Right, let's try that number to begin with. So disposal here. Now against the same rules, we deduct sales proceeds to a maximum of original cost. That was it 18? I think it was 18,000. £18,000 we deducted. Original cost was 30. So yeah, that is lower. We deduct therefore that figure. What we'll then attempt to do, having deducted the disposal, is to deal with, as we normally do, our normal writing down allowances. But that's where things will get a little bit different. Let me just get that number. 18 from 20,172 is 2,172. We would, of course, compute our normal writing down allowance of 25% in the normal, so 25%, I've gone back several years there, our writing down allowance of 18% there on our pool, our main pool. That figure would go in, transfer across, that figure would be in the allowances of the period. You can do an 18% calculation. The interesting one is about what do we do with this £2,172. Now that's where this so-called balancing adjustment comes in. Here, and only if we're dealing with a non-pool asset, if that individual asset is sold, that capital allowance computation in that column is not going to go forward and have future writing down allowances. If that individual asset has gone in this period, it's time to wrap up this capital allowance column, this part of the computation, and work out what we call a balancing adjustment. So let's just go back now to our notes here. And in note C of this particular section of dealing with our disposals, dealing with again, assets which are non-pool assets, we're told on the disposal of the asset, a balancing adjustment is computed by deducting sales proceeds, but remember, to a maximum of original cost. We still have that rule. Deduct sales proceeds to a maximum original cost from, of course, deduct from the tax written down value, and there will be a balancing charge if sale proceeds exceed tax written down value, and as we'll have to begin with our example, a balancing allowance if sale proceeds are less than tax written down value. Well, let's just check what we had on our example. We've got disposal proceeds of 18,000. We had a tax written down value brought forward of just over 20,000. That therefore means we are looking at a balancing adjustment that will be defined as being a balancing allowance. If the disposal, I've got the sneezes coming on again. Okay, right. Having taken away that £18,000, therefore, the 2172 is still a positive balance, and that, therefore, is a balancing allowance. What we're looking for here, if we've sold for less than tax written down value, there is still some unrelieved cost in relation to the ownership of that asset that has not yet attracted capital allowances. So what happens here? That 2172 that we have there, because we're going to remove this as a balancing allowance and therefore have nil on this column, it comes to an end. But that 2172 is then going to be restricted again to the business use. So that will be 80% business use. Now that means that we'll have a balancing allowance going in here, 80% of 2172. Forgive me a moment. 2172 times 0.8 equals, I make that 1,738. 1,738. Now, as a balancing allowance there, that 1,738 would be added to the figure of our capital allowances on the main pool, and you just add through and get your total allowances there. That would just be treated as a normal capital allowance, a final balancing allowance, balancing capital allowance to finish off the ownership of that particular asset. Go back to our note. What did it say? And a balancing allowance if sale proceeds are less than the tax written down value. Having computed the balancing adjustment, the amount assessed or allowed, that assessment is the balancing charge, we'll come to that in a moment, but our balancing allowance then is then reduced to the business proportion. A balancing allowance is then added in to the capital allowances of the period, whereas, as we'll see in a moment, a balancing charge would reduce the capital allowances of the period. So what we have said we do with that balancing allowance, remember, why is it a balancing allowance? Because we've sold it for less than tax written down value, i.e. we've not yet been able to claim all of the available allowances that the period of ownership and the net cost, we bought it for 30, sold it for 18, would allow us to have. So we pick up the remaining balance in the form of a balancing allowance. Now, it's a simple calculation to do, but what you now have to remember to do is to restrict that balancing allowance there to the business proportion. Again, make sure you do that calculation. That then as an allowance would be added to the other 18%, writing down allowance on your pool, the figure in there, and that figure would be the capital allowances of the period. We offered another possible figure of sales proceeds just to finish off this particular session together now, and that was alternatively 25,000. Clearly a figure that is going to be bigger than the tax written down value. So let's just see what the computation now would look like. Now again, I'll just deal with this non-pool column, the car with 80% business use, because nothing else changes. We had brought forward our tax written down value of, what was that? £20,172. £20,172. We then had the sale, the disposal. We sold for 25,000. Check. Are the sales proceeds less than the original cost? That was 30,000. Yes, they are. So we deduct the £25,000. What that will give rise to, well, let's get the number first of all. What do we got? 20,001, so it's 4,828, I think. 4,828. Yeah, I think so. Just check that with your calculator anyway. £4,828. Now, what we can see here is, unlike with the example above, where we'd sold for less than that tax written down value, we've now sold for more than that tax written down value. And what that means is that we've actually claimed more allowances over the period of ownership than we were entitled to. So what's going to happen, to the extent that we've got proceeds in excess of the tax written down value, there's going to be a balancing charge. Now again, we need to close off this column, so that's £4,828. But what do we do with it? We restrict it to the business proportion. And that will equal, let's get 4828 times 0.8 equals, hopefully, 3862 I'm looking at there. 3862. Now that is a balancing charge. That's a clawback in relation to allowances taken. So what's going to happen here is we would still have our 18% writing down allowance on the main pool, and that would go in here. Again, probably best if I show that. We had our main pool. What was that? 13,448. 13,448. We've had our disposal. We've still got 13,448. On it, we have a normal writing down allowance. That writing down allowance is your standard 18% on your main pool. So what have we got? Again, back to the calculator. 13448 was the tax written down value brought forward. No additions, no disposals to impact on that main pool balance. So that, therefore, is times 18%, is £2,421. I've got that. £2,421. Take it out. 2421. £2,421. Again, you get your tax written down value carried forward there to go on to the next accounting period. So what have we got? We've got an allowance available of 2421. We've got a balancing charge of 3862. We set off that charge against the allowance, but as you can see here, that balancing charge is bigger than the amount of writing down allowance available. So we're going to end up with a net balancing charge. Now you can work that number out, whatever is 3862 minus 2421. But whereas, if we'd had over all capital allowances here, what do we do with them? What do you always do with capital allowances? You deduct them from adjusted trading profit to give you tax adjusted trading profit, the figure that will form the basis of what is assessed in your income tax computation for that trading business. But what you've got here is a negative balance. The balancing charge is bigger than the other allowances available this period. So what that means is that that figure in there, instead of reducing the adjusted trading profit of the business for that period, will be added to it. It's going to be an extra profit. It will increase the profit of that period. And that is what is said finally in those notes here. If a balancing charge exceeds the allowances available of the accounting period, then the net balancing charge is added to the adjusted trading profit of the period, as we've just been saying. Okay, now there's a lot going on there, so it will be very important for you to make sure that before next time you go back through each of these examples, you go back through the notes and you learn these rules. Really important learning study area, this one. Again, capital allowances, like adjustment of profits, are always things that are going to be tested in your exam. Whether it's 2 marks, 4 marks, 6 marks, 8 marks, 10 marks, I don't know. But they will always be there. So again, you need to know. This is where the marks must be secured, because you know these areas are going to be tested. Just before we go, and I'll leave you to your private study before next time, one final point. Private use by an employee of an asset owned by the business. Again, typically the business has provided a car to an employee. It's a mix of business and private use. Well, that has no effect on the business's entitlement to capital allowances. What we have just been dealing with is, in terms of the non-pool asset, only where it is private use by the owner of the business, the proprietor. Private use by an employee does not impact on your capital allowances whatsoever. This is why the private use of an asset is irrelevant for companies where there is no proprietor. So, again, one of the differences we'll see in terms of capital allowance computations here for unincorporated traders to later when we deal with corporate tax is a bit like adjustment of profits. When it comes to these areas, actually in corporate tax, it's easier because there's no private use there to deal with in corporate tax. Everybody who works within the company is an employee of that company, whether it's an owner of the company or not. If you work in the company, you are an employee. And on that basis, there's no restriction. So you'll never see that business/private use issue in a corporate tax problem. So when you're doing objective testing questions, I'll remind you of this when we do corporation tax, but be very, very careful to see what's the name of the business. Are you dealing with an individual? So it's income tax, the rules we're studying now. Or instead of Fred, the individual, it's Fred Limited, a company, in which case it's corporate tax. And if it's corporate tax, then you're going to have nothing to do with private use by the owner, because it doesn't happen in corporation tax, only when dealing with income tax. So again, be aware. Watch out on those objective testing questions. They will lay traps for you to fall into if you are unwary. Who are you dealing with? Is it a sole trader, a partner in a partnership? Is it unincorporated, or is it incorporated? Only here, income tax, the unincorporated trader, where you have this issue of non-pool asset in relation to business use by the proprietor. Okay. More than enough for this one session. Make sure you revise through before we see you next time. There's just one other category before we move on to the next section in terms of this area, where we have the possibility of short life assets and something called a depooling election. Not as important as, in terms of exam significance and relevance, as what we've been doing today. So, or in this session, do please make sure that you're fully prepared, you've dealt with this, you're comfortable with it before we move on. I look forward to seeing you then.